My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do it, my friends. I'm just trying to make a little money. My job is not just entertain, but educate. Teach. Call me at 1-800-743-CNBC and tweet me at Jim Cramer. What can I say about this third quarter? The one we just put paid to. I mean, come on, it was a wacky, crazy 3 months where the unthinkable just kept happening. Today's action notwithstanding, Dow inching up 17 points, S&P advancing 0.42%, NASDAQ gaining 0.38%. The months of July, August, September gave us some outstanding returns. The S&P 500 alone at 5.5%. Not only that, but the notorious month of September, traditionally among the worst months of the year, actually delivered some terrific results. With the Dow climbing 767 points, S&P gaining 2.02%, NASDAQ jumping 2.68%.
House of pleasure.
Today, though, Jay Powell kind of spoiled the totally bullish narrative. He said in an interview that the Fed isn't in a real hurry to cut rates. That suggests the next rate cut likely won't be a 50 basis point cut, but who knows? If the data gets worse, if we have a very weak employment number on Friday, then maybe the committee will change its mind. You know, my view, this whole parlor game of second guessing is mostly a waste of time. The market was weaker throughout the day, but then got very ugly when Powell dropped the hold on a second bomb before rebounding into the close and then soaring. I think the late day rally showed the market's true colors. Now, the world is regularly filled with polarizing and sad days. We know that. We can easily come up with dozens of reasons why stocks should have been down for the bulk of the session, if not the month or even the whole quarter. In fact, the easiest tale for me to tell this evening would have been, here's 5 reasons why the market got obliterated. Sell. Got to limit it to 5 because I don't have time to list every potential cause of a big decline. That never happened. Problem is, that's bad journalism. See, when I was a cub reporter for the Tallahassee Democrat and the LA Herald Examiner, I learned that bad news sells, but good news, not so hot for the newspaper biz. That's how my late editor at the Her-X explained why I had to write tough homicide articles or get gruesome details about plane crashes or lurid tidbits about the deaths of movie stars when I just wanted to mix some good stories with the sordid tales. But here I am on Mad Money, trying to do something different. In a world where the horrid news writes itself, whether we're talking the Middle East or the hurricane-ravaged parts of North Carolina and the Big Bend of Florida where I once lived, good news feels like a scarce commodity to me. My late editor, he knew what people would read. He knew that if the cereal box and the paper were on the table in the morning, the more prurient my stories were, the less likely the box of Frosted Flakes would dominate the breakfast table conversation. So at the risk of telling some good news, let me give you 7 positive stories, 7 wonders of the world, or at least 7 wonders of the third quarter, the one just concluded. First, there was no hard landing. There wasn't even a soft landing. There was no landing at all. The economy never stopped growing even as inflation moved out and unemployment moved up, to quote Fed Chief Powell from earlier in the day. Can we get rid of the whole airplane dichotomy, please? The goal should never have been a soft landing. It should have been growth with little inflation. You know, that's exactly what Powell gave us. Well done, Chief. Second, Powell managed to do something else that's borderline impossible. He enacted a double rate cut without a big surprise factor. On the verge of this first of many rate cut announcements, there was a little back and forth about the possibility of a 25 or 50 basis point cut when the Wall Street Journal reported that the double cut was, in fact, a possibility. You know, that was perfect. Just a great leak to the Journal, because when we actually got 50, it didn't cause a panic. Powell is the least drama of any Fed chief I can recall, and I recall a bunch of them. He is patient to a fault with the press. He's intensely private. I say good for him. Third, going into this past quarter, we've been struggling endlessly with a market that only seemed to care about the Magnificent Seven. When would the rally finally broaden out to the other 493 stocks in the S&P 500, to say nothing of the cheap small cap outside the index? Well, that's no longer an issue. The small caps soared. The market broadened. There were many stocks that rallied, and a lot of money was made away from the 7. Banks, utilities, retail, healthcare, housing, transports. They all had their day in the sun. No more narrow market, people. Wall Street came in the third quarter liking the same old, and came out liking everything, including the same old. Oh, and get this. NVIDIA, it took it on the chin. showing that CEO Jensen Huang is still human, even if I insisted to be called the modern-day Da Vinci, because the guy's a true Renaissance man. Fourth, despite the fact that we're headed into what Michael Semblis, chairman of market and investment strategy for J.P. Morgan Asset and Wealth Management, calls the most polarized election in 100 years, the market chose to ignore the drama. The market didn't even treat the Biden debate fiasco as a speed bump, and adjusted without an ounce of trepidation when we got changing the guard from Biden to Harris. These changes mattered immensely to our United States of America, as did the attempted assassination of Donald Trump. But Wall Street might as well have been located on another planet. Fifth, we actually had our first break in the formerly rampant housing inflation figures as we finally begin to see extra homes coming on the market. I think this new housing supply might be the break we need to get a handle on the last intractable asset class that refuses to go down in price. Right now, it is tipping in Powell's favor. At last. Sixth, the war in the Middle East is raging and oil is going lower. I will have more on the incredible anomaly later in the show, but suffice it to say, most people would not assume that was about to occur. I kept hearing that we'd have stagflation led by oil. Dream on, bears. Didn't happen. Seventh, the Chinese market managed to put together a real rally, despite the economic news being overwhelmingly horrible. President Xi got stocks higher when the government ordered buybacks and a lot of free money. Now that the Chinese markets had a gigantic move, okay, now we know that many U.S. investors will pile in, take the Chinese out of some really awful positions. Bad move, but it'll certainly help bolster China's ailing economy. Now, there are plenty of other miracles in the third quarter, gigantic run in anything nuclear, because we desperately need more electricity to feed the data center beast. I was worried about GE Vernova when it was spun out, but it turned out I thought it might be a bust. Turned out to be an incredible mover. Eli Lilly's stock climbed on overwhelming orders for GLP-1 drugs, but not a single food or beverage company saw a decline in sales. Talk about a wonder. Starbucks got a new CEO, Brian Niccol, and the stock committee went up 20 points, and it never gave back those gains. More on that in a moment. Meanwhile, all the real ugly duckling housing-related stories turned into beautiful swans. Bottom line, for once, good news was actually good news and interesting. You'd much rather talk about the terrific third quarter at the breakfast table than focus on what's written on the back of a cereal box, wouldn't you? So the next time you start to feel horrible about the state of the world, remember that miracles can still happen, at least in the stock market's third quarter. Let's take questions. Let's go to Robert in New York. Robert.
Jim, how are you today, Jim?
Robert, I'm doing okay. What's happening with you, partner?
I'm doing really well. I was out on my boat today, and everybody's like, oh, how do you afford this boat? And I said, it's very simple. You listen to Cramer, you get some great stock advice, and you make smart decisions that Cramer tells you what to do. And this is how you get the boat.
Robert, I'm looking at my staff, and I'm telling you, I always say that when Robert calls, he's got horse sense.
Jim, I'm telling you exactly the facts, okay? And let me tell you something. The new Powell indicates further rate cuts, okay? And you said you can't fight the Fed. I listened to you religiously, okay? And Marty Zweig was one of the greatest investors of our time, and that was his thing, okay?
That was his thing, and don't fight the tape either when you're fighting. Don't fight the Fed, don't fight the tape. All right.
Because everybody says, oh, we're going to sell because they're going to lower the rates. It's baked in. But Cramer has taught me through the years that's not necessarily true. Okay?
All right, Robert, let's get a stock going, then we're really okay.
This next stock could benefit big time with the decrease in interest rates, not to mention the Apple Pay partnership that could be used, and there are no late fees, okay? It's the antidote to credit cards, lower delinquency than any other credit cards out there, and they made this deal with Apple. They have a great underwriting department, Affirm. Okay.
Oh, geez, Affirm, that's Max Levchin. He and I are we're like about as pals as Max has. And I think that Affirm is a real good stock and is going higher. Twofer, I like PayPal too. Let's go to Lou. They're Lewin, not booing, in Pennsylvania. Lou.
Hi, Jim. Thanks for taking my call
and
for having such an outstanding and competent staff. They are what makes
they're so smart. And I missed them last week. I tell you, I was telling my wife I missed my staff. She goes, Jim, will you give me a break? But, I did. Okay, go ahead.
They are what makes your show really function so smoothly. I appreciate it.
Thank you.
I'm calling to get your opinion about a large pharma company you've extolled in the past, but which is down about 2% despite a very good day today over the last 3 months. It's likely best known for its GLP-1 drugs for diabetes and obesity, but its price is now a bit obese itself. Maybe it should take some of its own medication. There are several new upcoming competitors, but also new indications on the horizon. Company, of course, is Lilly. What are your thoughts?
Okay, this is a great point, Lou. And what's going to matter with Lilly is the moat it has by building these gigantic factories, which cost a fortune. Reminds me of the way Intel used to be in the heyday. That means in the 90s. You can't really compete against a company with that amount of firepower. I remain steadfast on Eli Lilly for my charitable trust, and I urge you to read some of the stuff I've been writing about Lilly, because I think I got a real beat on it. And thank you for those kind comments about my staff. Not my wife's going to be about our staff, because it's not my staff, it's our staff. All right. For once, good news was actually good news, and it was able to send stocks higher in the third quarter, which is proof that miracles can still happen. Man, tonight, last week the FDA approved Bristol Myers treatment for schizophrenia in adults, and I am learning about the implications of this new class of medicine. Hey, by the way, it's one we haven't seen in decades from the company's top brass. You better listen to this. Then, it's a battle of two animals when it comes to a turnaround at Starbucks. I'm laying out the bull and the bear case and where I come down. And H.B. Fuller makes a host of adhesive from labels to solar panels. So should investors stick with the stock? I'm checking in with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Got some really good news. There was a big breakthrough on the mental health front last Friday when we learned that the FDA approved Bristol Myers' revolutionary new schizophrenia drug. It's called Cobenfy. This thing represents a whole new class of drugs, the first truly novel treatment of schizophrenia for more than 30 years. That's huge because traditional antipsychotics have truly horrifying side effects. They'll cause so much weight gain. You get diabetes. They'll cause all sorts of movement disorders like facial tics. They'll make you sleep 14 hours a day. That's why so many people struggle to stay on their meds. The cure is almost as bad as the disease. But Cobenfy doesn't have these side effects. Bristol Myers paid nearly $13 billion for Karuna Therapeutics precisely to get their hands on this drug, and I think it's worth every penny. Of course, Bristol Myers still has some major patent cliffs to get past in the next couple of years, but this drug could help them get there. Don't take it from me. Let's go to Dr. Chris Boerner. He's PhD, Chairman, CEO of Bristol Myers. Learn more about this amazing drug. Dr. Boerner, welcome back to Mad Money.
Jim, thanks for having me. It's great to be here, and we are thrilled with the approval of Cobenfy and the opportunity to bring this innovative medicine to patients with schizophrenia. You know, this is one of the things we've been focused on in my first year as CEO, and I have to say, we're transforming this company to deliver long-term growth, and this is a big piece of that.
Now, when I met you, my first reaction when you told me about this is like, listen, be careful. The brain, everything that goes wrong with the brain, it's almost impossible to figure. Why did you have so much confidence to spend that much money in Karuna?
Well, Jim, we acquired Karuna primarily because the science is so incredible here. This is a new approach to treating schizophrenia. And remember, this is a patient population that is in desperate need of something new. There hasn't been anything fundamentally new in decades. This is a patient population, as you point out, that have horrendous side effects with existing therapies. You've got being tired all the time, not being able to focus, significant weight gain. For patients, many of whom are in their late teens and 20s, these are potentially debilitating side effects. And Cobenfy does not have those. Because of the way it operates, we're seeing efficacy in line with the best of existing therapies, but without those side effects. And that's why we're so excited to bring this new medicine to patients.
A lot of people say to me, why don't the people who are schizophrenic stay on their darn meds? Well, the answer is it's been worse than the disease sometimes.
That's precisely right, Jim. 1.5 million patients in the United States are treated with schizophrenia. Over 3/4 of them discontinue therapy, and they do so precisely because of these side effects. And that's why there's so much promise in this medicine not having those side effects.
Now, we've got approval for this. There are other indications that perhaps, I don't want to get you in trouble because I know that I don't want anyone to think that you would ever go for off-label stuff. But there have to be some studies that you're doing for some of the illnesses that are, let's just say, adjacent to this?
Well, one of the things that we really liked about Karuna was with Cobenfy, you have a new mechanism. And because of the way this product works, it targets unique receptors on the brain. We think it has the potential in bipolar disorder, potentially Alzheimer's disease psychosis. We are even seeing the potential for cognition benefit in Alzheimer's disease and maybe autism spectrum disorders. So we've got a robust development program, which we're prosecuting very quickly.
All right, so let's talk about the total addressable market. If all these worked out, and we know we can't assure that they do, but now you're starting to talk about millions upon millions of people.
Well, this is a potentially very big opportunity for us to help a lot of patients across a series of diseases in desperate need of innovation, like schizophrenia. I mentioned 1.5 million patients who are being treated today, and they're being suboptimally treated. And that's what we're excited about with Cobenfy, initially in schizophrenia, but there's potential opportunity across a spectrum of diseases, and that's why we were so excited with the Karuna transaction, which we did as one of my first moves as becoming CEO back in November.
Went off for the toughest stuff. Now, from my work with the American Brain Foundation, what I know is that you've got some numbers that you were using, but there's actually could possibly be millions more. But there's so much stigma to problems with the brain that people just say, hey, I got schizophrenia. What do you got for me?
Yeah, look, I have to tell you, this is one of the most exciting things about this product is we can destigmatize this disease. This is such a golden opportunity. Again, the first new innovation in decades here. And so we're incredibly excited about the potential to help a lot of schizophrenia patients today. We have an additional indication in schizophrenia, which will be an adjunctive or combination use next year. Right. So there's a ton of potential here to help patients initially in schizophrenia and then again across a host of diseases.
Well, you know, when you made that I was very excited about it, but you wanted to kind of walk me back a little because you said, listen, we do have some patent issues that you should bring out. It was you who brought them out. So I want you to talk about what awaits the next 2, 3, 4 years. And is the dividend safe given how tough things could get?
Well, listen, Jim, we are incredibly excited about the long-term potential of the company. We absolutely are facing a number of patent challenges, but keep in mind a few things. First, we're not the first company to go through this. We've had big patents that we've had to address in the past. We know how to do this, but what do you have to have? First, you have to have a portfolio and a pipeline that can give you growth. Right. We have that. Right. You have to have a strong financial position. We have a great balance sheet, including a very strong dividend. And you have to execute, and that's what we're squarely focused on. And we do that, I'm very confident we can navigate the next few years and exit this decade as one of the fastest growing companies.
Okay, so let people know, what is something that right now produces billions that might go down because of the way generics infringe? Well,
right now we're addressing the Revlimid patent expiry.
That's what I wanted you to talk about. And that deal was a good deal while it lasted, so to speak.
Well, the nice thing about Revlimid is that it generates a lot of cash for the company, cash that can be reinvested in new opportunities, and that's what we've done. And we're well over halfway through the Revlimid patent exposure. And the nice thing is, Jim, we've got the core foundations to grow this company. We've got a strong pipeline. We've got good growth drivers today that can help us over time compensate for the loss of patent exclusivity. And the nice thing is we're in a very strong financial position. That means we can continue to invest internally and bring in assets externally if it makes sense.
All right, so Chris, how do we explain to people why this drug at its price is actually, I don't want to call it a bargain, but it's so important that it should be priced like this?
Well, listen, Cobenfy is a fundamental breakthrough, and we've priced this drug to thread the needle. Reward the innovation, but also ensure that we get broad access with this product. As you well know, innovation without access is not innovation at all. And so we've been focused on, first, ensuring patients have access to this product. We've been working with payers for months to ensure that there are no undue hurdles. And we've got a very, very robust patient assistance program that will come in if any patients experience problems. So again, we're focused on delivering this this innovation to patients as quickly as possible and ensuring broad access.
And once again, I want people to know, weight gain, no. Terrible restless leg, no. Tics, no, right? None of this.
We don't see any of the side effects typically associated with this class. And what's important is we see best-in-class efficacy without those side effects.
And that's why $1,800 a month, it's not that bad versus what the alleged standard of care was before you went after this.
Yes, that's exactly right, Jim. We look at this as a golden opportunity to change the conversation around schizophrenia. We have the innovation to do it. And right now, we're ready for this launch, and we are squarely focused on delivering this to patients.
Thank you.
It's my pleasure to be here, Jim.
Absolutely. That's Chris Berner. He's the chair CEO of Bristol Myers, BMY. Mad Money's back at the As of 3 weeks ago, Starbucks is under new management. In mid-August, the Seattle-based coffee chain gave former CEO Laxman Narasimhan the boot after a sustained period of mismanagement and decided to bring in Brian Niccol, the mastermind of the turnaround at Chipotle. He formally took charge 3 weeks ago. Now, regular viewers know I'm a huge fan of this man. He's a turnaround artist. It's exactly what Starbucks needs right now. And Wall Street clearly agrees as the stock surged from $77 to $97 and change since his appointment, with the vast bulk of those gains coming pretty much immediately. But not everybody's on board with the new leadership. Last week, while we were out, 2 different sell-side analysts took the exact opposite view on Starbucks. Last Tuesday, a team of analysts at Jefferies, led by the appropriately named Andy Barish, downgraded the stock from hold to underperform, meaning sell, while slashing the price target down from $80 to $76. Good luck with that. Then just 2 days later, a different team of analysts at Bernstein, led by Danilo Gargiulo, upgraded the stock from market perform to outperform, meaning hold to buy. They raised the price target from 92 to 115. Now, personally, I have to tell you, I absolutely love these about faces. I like to go put them against each other because they let you pit the best arguments of the bulls and the bears against each other, allowing you to make better informed decisions about the stock in question, and also, of course, make you a much better stock picker. Let's start with the bear case from Jefferies. In their note, cleverly titled, "Will take some time to brew a fresh pot." The Jefferies analyst argues that despite all the enthusiasm for Brian Niccol, the fact is that turnarounds take time and they're also expensive. So any efforts to improve the business will hurt the company's near-term earnings power. Okay. They say they saw the stock had gained $25 billion in market cap since we learned Niccol was coming in, and they think that's, quote, too much too soon, end quote. Okay. Basically, Jefferies recognizes that Starbucks has very real problems, and you can't just fix this stuff and restore the brand overnight. And you certainly can't fix them for free. In the end, Jefferies argues that the earnings estimates for Starbucks need to come down. More importantly, they expect management will give low-ball guidance for their 2025 fiscal year when the company reports in early November. That's why they cut their earnings estimates from 2025 and 2026 to levels that are well below the Wall Street consensus. That is important. And that's how they end up with the $76 price target. If they're right, then all the gains since Niccol's appointment would be wrong. Sobering. Hey, how about the bull case from Starbucks from Bernstein? Well, again, this is basically the exact opposite of the Jefferies call. In a note titled, Grande Comeback Upgrade to Outperform, they argue that the current valuation does not fully appreciate the earnings power that Starbucks could unlock. Then they go on to say they acknowledge the turnaround will take time. But crucially, they tell us, quote, we believe that it will not need to be completed for the stock to start to work, end quote. That's right. The stock market is all about expectations. If you wait until the turnaround is fully executed, you're going to miss out on most of the gains. The whole show here is predicated upon that concept. The Bernstein team said that the appointment of Niccol as CEO and chair will free up management to draft a plan aimed at operational stability versus chasing growth at all costs, end quote. They said that they expect additional management changes and, quote, the reduction of spans and layers in the organization to act as a catalyst for the stock amid lower general and administrative expenses and streamlined decision-making, end quote. Sounds good to me. Bye. The Bernstein analyst went on to argue that, quote, the operational focus of a more streamlined Starbucks will have several tangible benefits, like one, the stabilization of store operations, faster throughput enhancement in brand and value perception, that is, improved store ambience, transparent pricing. And purposeful innovation should result in positive traffic growth. Yes. They can see that less customization drinks might pressure same-store sales, but said that the benefits from all these other factors should lead to, and I'm going to quote here, a reacceleration of traffic-driven comparable sales growth, end quote, which is exactly what you want if you're a shareholder. Finally, Bernstein argues that, quote, despite investments in labor, equipment, and technology, we expect the operating margins to improve to historical highs by 2028, given the sales leverage and operational efficiency unlocked by the investments, end quote. Basically, Bernstein's agreeing with the Jefferies analysts that investments are coming, but they're less focused on the hit to earnings in the next year or two, more focused on the potential earnings gains in 2027 and 2028. Now, even the bulls at Bernstein believe the estimates for 2025 do need to come down. In fact, Bernstein's expecting lower numbers than the bears at Jefferies for the next 12 months. However, from fiscal 2026 to fiscal 2028, they're projecting a tremendous 20% compound annual growth rate for earnings. That'd be amazing. The price targets based on 2026 estimates, that's how they see the stock going to 115. So where do I come down? Look, we've got a substantial position in Starbucks for the Charitable Trust, and we haven't sold a share since the news that Brian Niccol was taking over. So clearly I am siding with the bulls on this one. Again, I don't expect a strong fourth quarter. The new guy only started 3 weeks ago. I don't expect particularly good earnings in the 2025 fiscal year either, although I'm not sure whether that means flattish earnings growth or maybe a genuine down year. In the end, though, like the bulls at Bernstein, I'm willing to look through a weak year if it means Starbucks can come out the other side much stronger, and I believe Brian Niccol can pull that off. Doesn't mean the stock won't sell off if management lowers expectations, something that I do expect. It just means I'd recommend buying more Starbucks into weakness. In the end, I have more faith in Niccol's ability to get Starbucks back on track than the bears Jefferies analysts. If you look back on his past 6 years at Chipotle, some of the best things that he's done have been on the operational front, creating robust digital ordering infrastructure, configuring stores with things like second preparation lines and drive-thrus to make sure they're churning through all their additional orders without creating long lines and a negative in-store experience. He is basically a throughput expert. And throughput is, frankly, the biggest problem for Starbucks right now. Plus, don't forget about all the positive news out of China this week. This is the second largest market for Starbucks, and it's been a total dog. But now the Chinese Communist Party has finally started aiming some stimulus directly at consumers, which should translate into a stronger economy and better business for companies like Starbucks with big China exposure that have lost share to cheaper alternatives. And that would be a huge positive. So here's the bottom line. When you really drill down, the bulls and the bears on Starbucks don't seem to disagree so much on the facts. Everybody acknowledges the near-term numbers will be distinctly suboptimal. It's more about emphasis. The bulls are willing to look past short-term pain because they believe in Brian Niccol's ability to turn this thing around. But the bears don't want to take that kind of risk. As for me, I am a bull on Starbucks with this new CEO. I think he's got such a great track record that he's more than earned the benefit of the doubt. Niccol's worth every nickel they're paying him. All right, let's go to Frank in Michigan, please. Frank.
Hey, Mr. Cramer. It's a pleasure to talk with you.
Right back at you.
We're calling from a town that, is turned around. We got the Tigers in the playoffs. We got the Lions playing tonight in the Monday Night Football. And I'm trying to see an analogy here. I like a stock that I've had since $28 called BJ's Wholesale. Could this thing be a champion one day like a Costco? Is this possibly a baby Costco?
Okay, this is a really tough call. I mean, I like BJ's. We go to BJ's. But we're a Costco people. Like many people, this thing sells at 21 times earnings, so it's a little bit cheaper than Costco. But I think it deserves to be cheaper. Costco's the better one. But I do want to congratulate you guys in Detroit. I got Sam Laporta going tonight, and it may not matter that much. But, boy, I sure do like your team. And go Tigers. They're pretty great. Let's go to Rodney in Texas. Rodney.
Booyah, Jim.
Booyah.
How are you today?
I don't know. Back from vacation. The Eagles lost. I'm trying to regroup, frankly.
I understand.
Mets won, which I don't really care about, but my producer sure does.
I got you.
I wish I didn't care so much about sports, Rodney, and more about making big money for people. But right now, I'm possessed by how bad the Eagles are. Let's go to work.
All right. Yes, sir. So here's my question for you. So with the recent rate cuts that we've had here and the Fed's coming out with the what their plan is for the next to the end of the year for the rate cuts coming up. So my stock is Airbnb. My average price is $143.
Okay.
What do you think is going to happen with all these rate cuts? What's going to happen with Airbnb?
I think I'm so glad you put it this way, because I think that Airbnb is one of those companies that will actually do better when rates come down and people start doing more traveling. But most importantly, this thing is run by Brian Chesky. He has always been very conservative. And then when the numbers come out, I feel pretty darn good about it. I suggest that you actually buy a little more. It's down 7% for the year, and I like it. All right. The bulls and bears on Starbucks both seem to realize that the company's near-term numbers will be suboptimal. But I'm siding with the bulls on this one because their new CEO has just such a great track record. Much more mad ahead, including my exclusive with H.B. Fuller. The Fed's starting to cut and China launching a stimulus push abroad. Could an economically sensitive company like H.B. Fuller be worth looking at here? I'm sitting down with the CEO, and the decline in the price of oil is pretty remarkable. I'm using history as my guide to make sense of the latest action. Of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. When the Fed cuts interest rates and the Chinese government finally takes real action to directly stimulate their economy, you might want to look at companies that have some economic exposure, but not too much economic exposure. Companies like H.B. Fuller, which makes adhesives for everything from labels on your to-go coffee order to commercial roofing products to solar panels. Here's a stock that's basically sloping quietly higher since the Fed declared war on inflation at the end of 2021. Now that our central bank's back in easing mode, could it be ready to roar? Let's take a close look with Celeste Maston. She's the president and CEO of H.B. Fuller to find out. Ms. Maston, welcome to Mad Money.
Thank you so much for inviting us.
Well, Celeste, this is one of those companies that I think we need to know more about because it's consistent, it's been around forever, it's done great, and you've been a steward who's really made it pretty much diversified. So why don't you, because it's first time, give us a little overview about the company.
Absolutely. So we are the largest pure play adhesive company in the world, Jim, and we're invisible. We're in everything from baby diapers and cereal boxes to aerospace and electronics. But there's three really important things to remember about this industry and H.B. Fuller. One is it's an $80 billion industry. Second, less than 2% of the end product cost is adhesive. And finally, H.B. Fuller custom tailors a lot of the adhesives that we're selling to big OEMs. Over half of our SKU base is custom tailored.
Now, if it's custom tailored, then you don't have that level of cyclicality that we might see from some chemical companies. You're kind of built in to a lot of different businesses. I know these end markets I like very much, engineering adhesives, but hygiene, health, and consumable adhesives, that has almost no economic exposure, and that's kind of what I want if we have a slowing economy.
Yeah, if we have a slowing economy, it's a very stable grower, but also we're in the midst of a renaissance in these consumer product goods that are disposable, Jim, because people want sustainability. Companies are driving sustainability and the circular economy. And so when you look at our overall product developed pipeline, over 60% of those projects are related to sustainability.
Now, you also have geographic diversity that has been concerning to me. You have a lot of China, and I've been waiting for something good to happen in China. Now, in the last 10 days, we've actually seen a kind of an explosion in the stocks, but we've also seen dramatic stimulus. China's been a problem for you. Can it possibly go to a positive?
Absolutely. So if you look at our organic growth rate in China and you strip out solar, we've had mid-single digit, sometimes double digits in some quarters growth, organic growth in China. So really, we've picked the right places to play in China overall, electronics and automotive. Solar is certainly not been that.
Right. See, I know I wanted to mention automotive. I'm glad you brought it up. And obviously, in the last week, we've heard nothing but negatives about automotives. But I don't know whether that necessarily impacts your business that much.
No, it really doesn't. So we've been growing our automotive business largely through share gains.
Okay.
Both share gains in the applications in which we play, and there's a lot more adhesive used in a car than there ever used to be, but also by really focusing on new geographies. And actually the Chinese EV producers have been very successful, and we've been successful with them.
All right, now you are tough on yourself because you admit that your volumes have been disappointing, and yet at the same time, I don't know how you can necessarily outgrow your end markets.
Well, we hold ourselves to a high standard, Jim. Absolutely. So when we look at our markets, we want to be growing with the market and gaining share. We've been very successful taking share, and we're going to grow beyond market rates because we have a good inorganic growth strategy. Our M&A strategy is delivering a couple of points of growth every year.
Now, tell me about an area that we're very excited about, which is a data center chip manufacturing. You're in it. It's pretty good.
It's great.
Right.
It's great. That is really our roofing business is very involved in data center roofing, big chip manufacturing, institutions. And so we've been very successful in that space. But again, part of that is the market demand for those products. But the other part is, again, share gain through innovation. We have a new sprayable adhesive that really saves labor in application on the roof deck. And that, plus relationships with OEMs who we're constantly innovating with, has had a big impact.
How do you get your name out, so to speak? I mean, one of the things that when I was going over all the materials, H.B. Fuller, it's almost just like Fuller's never really identified within these products. So, I go over the end markets. I go over, engineering adhesive, construction adhesive. It's not like your name is blasted on any product.
No. So what do? We go on Mad Money.
Well, there you go. I think that's absolutely right. I mean, look, you're the kind of company that delivers the kind of consistent growth that a lot of people should be seeking. Yeah. We have way too many people who want to shoot the lights out. I just kind of want to have grow over time. How many years?
135 years.
It's a pretty good track record.
I
want to thank Celeste Maston, who knows where to tell the story. Mad Money, President and CEO of H.B. Fuller, a very old company with a very new business model and a lot of great end markets that I think are going to improve in the next couple of years. Mad Money's back in.
Thanks a lot.
It is time. It's time for the lightning round. That's right. Quick round. Holy saving the stock. Bye. So don't stock cards. Everybody play this out. And the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Mike in Tennessee. Mike.
Hey, Jim. Thank you for taking the call.
My pleasure.
I've ridden the Cracker Barrel horse for quite a while here, and I'm kind of tired of the way it's going. Would you get out of Cracker Barrel and go into Home Depot?
I would more than look. I like Home Depot and I'm for the Chapel Trust, but I got to tell you, I'd rather double down on Cracker Barrel. I think I've got to tell you, I think that Julie Messina, she's doing a good job. And did you notice the stock starting to lift last week? Please do not sell Cracker Barrel. Let's go to Eric in Utah. Eric.
Hey Jim, how's it going?
Not bad, Eric. How about you?
I'm doing great. Hey, Bell Ring Brands, BRBR is the ticker. They provide various nutritional products in the United States. Company offers ready-to-drink protein shakes, other beverages. The stock had a recent pullback in July and looks to have solid technicals, trending in the right direction. With a 4 PE of 31 and a price to sales of 4, profit margin just below 12%. Is now a good time to buy, or is it stock?
I don't like to punt, but I have to tell you, I do not know Bell Ring. And I've got to do more work. The protein shake, look, but as soon as I hear that, I say, whoa, wait a second, we got to figure out how that's marketed and stuff. So let me come back on Bell Ring and do a good job for you. You deserve that. Let's go to Lisa in Rhode Island. Lisa.
Hi. Thanks for having me on.
My pleasure.
I'm calling in to see what you think about Redwire stock, RDW.
Everybody wants to be in the space business, and I've got to tell you, I don't. And I'm going to suggest that if you want to be kind of in an auxiliary space, just go with Tesla. This is a Elon Musk became. He owns this market, and I don't. It's not Tesla, but I don't want to go against him. Let's go to Robin in New Jersey. Robin.
Hey, Jim. I have a question about Kava. My husband and I purchased it in May, and it's been up 65% since then. I want to know if I should buy, hold, or sell.
No, you got to hold Kava, and if it comes down, I want you to be able to buy more. It's one of the great new concepts that we have seen in this market. Let's go to Bill in Massachusetts. Bill.
Hi, Jim. Thanks for taking my call.
Thank you.
I'm a club member, and I was thinking about buying some more Nextracker. I'd love to know what you think about.
Here's what I want you to think about Nextracker. Nextracker does not, I'm going to use an old term from when I worked with Jim Cramer in trading desk. This stock acts poorly. And it is a club stock, and we had Dan Sugar on, and the stock acts as if it is going to have a shortfall. And until we see that next quarter, I am not going to want to trust Nextracker because it is one of the most poorly acting stocks on good and bad days, and I find it incredibly disturbing. Incredibly disturbing. Let's go to Taj in Florida. Taj.
Booyah from Boca, Jim.
Love
I
Boca.
got left waiting in line the last few times I called in, so I got to throw in a twofer this time. A local company based down here in Boca, the most obvious Trump trade if he wins, Geo Group. And the other stock I have in mind is HSBC. If this is really the bottom happening in China, then why hasn't HSBC done anything?
Well, let me do I know the HSBC. Frankly, it's just okay. If you want a foreign bank, please own Banco Santander. That's a real good one. Let's go to Mark in Florida, please. Mark.
Booyah, Jim.
Booyah, Mark. What's up?
Long-time viewer. Thank you for everything you do.
Absolutely.
Listen, I saw you on a stock trading segment with Carl and Faber during the Formula One event in July, and you mentioned two stocks then. One was sub 72. I put it on my radar, and after watching it go up slowly for about a week or two, I finally pulled the trigger at 74 and 75. And I made some mad profits. But since reaching a new 52-week high and some raising the price target for 20%, Jim, how much longer can the honeymoon last?
What's the stock?
Shark Ninja, sorry.
Oh, Shark Ninja is... I mentioned Next Tracker and execution. I feel very badly that I had to be as tough about that. The opposite on Shark Ninja. These guys execute like you wouldn't believe. I wish I had bought that for the trust instead of Next Tracker, but I didn't. That's woulda, shoulda, coulda. What a stock. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, history rhymes, but no two barrels are exactly alike. Cramer explains how we've come a long way from the oil panic of generations past. Next.
With the Middle East potentially heading into another regional war as we head into the Jewish high holidays, let's talk about what's changed over the past 50-odd years. Back in 1973, Egypt and Syria invaded Israel on the holiest day of the year for the Jewish people, Yom Kippur, and initially had tremendous success as Israel was caught unready because of the holiday. If the United States hadn't intervened and resupplied Israel, it might have been wiped off the map. They turned things around, though, and Nixon had to talk them down from taking their army all the way to Cairo. But I bring this up because the Yom Kippur War had global reverberations. Once our country started airlifting munitions to Israel, the Arab members of OPEC imposed an embargo on the United States. OPEC still had teeth back then. The price of oil quadrupled. It's been a long time since 1973, but Israel's been at war for the past year. And all along, many people thought something similar could happen again. Even as the situation escalates on the Lebanese border, OPEC hasn't lifted a finger. In fact, Saudi Arabia, the country that led the 1973 embargo, actually took this moment last week to abandon its unofficial price target of $100, $100 a barrel, and decided to increase production. The Saudis have resigned themselves to lower prices. Normally, when tensions escalate in the Middle East, the price of oil spikes. This time, the price of oil fell several percent. Now, some of the price stabilization came from us. Our country was producing 9.2 million barrels a day back in 1973. We now produce 13.2 million barrels a day. We, not the Saudi Arabians, are the world's largest producer. We're the so-called swing producer because we could pump out another million barrels a day if we had to. I mean, that's how we broke OPEC. Plus, Russia's producing full out in order to finance the war against Ukraine. Even with Western sanctions, they just sell their crude to China and India. But as someone who was around in 1973, it's like night and day. The oil embargo 51 years ago pummeled the economy. Between the high price at the pump and the shortages, it was a real big deal. So we had a tremendous amount of stagflation. Some feel it was a lost decade for the economy, specifically because of that oil embargo. In fact, there's still widespread belief that the price of oil could skyrocket any minute. I think these people are wrong, but they're not going away. Of course, a spike in oil prices could still happen, although it won't be an OPEC embargo this time. Maybe Yemen shuts down the Suez Canal with its missiles, although now that Israel's shooting back at the Houthi militants, I don't see them getting more emboldened. Maybe the war gets much wider and oil facilities are damaged. Maybe the Saudis change their minds, although it's borderline impossible. The organizations that Israel's fighting against are backed by Iran, and Saudi Arabia hates Iran. But for anyone who's lived through the embargo and understood its economic consequences, the actual decline in the price of oil right now, it's remarkable. More importantly, it's great for the United States. We paid a huge price to back Israel 51 years ago. But with OPEC broken and Saudi Arabia more hostile to Iran than Israel, that's not going to happen today. I think when we look back, among other things, we may say that 2024 was the year we should have had stagflation, but we didn't. And that's a big reason why the first 9 months of the year were so unexpectedly terrific for the stock market. I like to say there's always a bull market somewhere. I promise I'd find just for you right here on Made Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.